Travel stocks have seen some wild swings over the past 2 years. First slumping, then soaring, then slumping again post-pandemic. The cruise lines are now trading back at the same levels we saw in early 2020 when the pandemic first hit. So which names here are the buys and where should you bail in the travel sector? Let's ask Gina Sanchez with today's 3 buys and a bail. She is Chantico Global CEO and a CNBC contributor. Gina, welcome. Your first couple buys have a common theme here. The first one is Marriott. We teased it earlier, down 26% from the highs. Why are you a buyer?
So Marriott right now is a stock that is, they've been telegraphing that they have very, very strong occupancy and that occupancy is continuing to improve. And one of the things that I said even a long time ago when we were in the middle of the pandemic is if you want to take your family on a vacation, the only thing that qualifies it as a vacation is a hotel. You can skip the plane, you can skip everything else. As long as you get to a hotel, the kids are happy. And I think that's going to be the theme this summer as people are trying to save money. Marriott has a fantastic offering, obviously, but they also are they're better valued than some of the other hotels like Hilton or Hyatt. They're trading at 13 times. That's actually pretty attractive right now.
Concerned about whether we call it an actual recession, a technical recession, the loss of consumer real income growth and spending power.
Yeah, that is an issue, obviously, and if you look at Marriott, it also benefits from business spending where you have a little less. It's not quite as elastic as consumer spending, but even there, you're hearing companies that are kind of reducing their travel budgets as well. But Marriott is a beneficiary, and again, they have strong cash flow, they have a good balance sheet, they have good debt to EBITDA. And so the company itself is just positioned to weather this volatility because they're getting both the business travel as well as individual travel, and their balance sheet is good. All
right, let's turn then, sticking with the hotel space, but to a different name, Choice Hotels. This is your second buy. It's down 25% this year, and they recently announced an acquisition of the Radisson Hotel brand. Is that deal-making part of the attractiveness here?
Absolutely. And part of the reason that they're able to do that deal making, Kelly, is because they have an extremely strong balance sheet. If you look at their debt to EBITDA, they're probably one of the best in the industry. So they are in a position to be taking advantage of the volatility and expanding their line. The other interesting thing about Choice Hotels is because it's this is like, Choice, this is Clarion, this is a little lower down the food chain, so it's more affordable for people to come and stay there. It's more of a family hotel. It also has probably some of the biggest margins in the business. It's 40% margins. That's not bad. And so, all of the things line up for them to be able to deal with rising inflation pressures, et cetera, and just they have a really, really strong balance sheet.
Yeah, Pat Pacious, the CEO we've had on a number of times here as well. All right, finally, a name that is a financial, I guess, technically, but doubles as a travel name, Amex. Down only 14% this year. It's held up well, but again, we have recession and sort of consumer concerns lingering.
Yeah, the question is, well, will the kind of loss of consumer spending hit the credit cards? But the other side of the credit cards is the rise in interest rates is actually benefiting them. And so, we actually like all of the credit cards. We own Visa and MasterCard at Lido Advisors. But American Express is one of those that's just gotten a bump up by a few of the analysts. And if you look at the outlook, it's a little better priced. It's got all of the it checks all of the boxes. It's got, great margins. It's got a good balance sheet. And so, we're sort of banking on the fact that what they lose in consumption, they're going to gain on the interest rate play, and vice versa. When we get to the other side of this, they'll also be pretty well positioned, to sort of keep participating on the consumption side. So what you lose in one, you're gaining in the other, and you do need some interest rate protection in your portfolio.
Interesting, and their forward PE under 15 as well here. All right, those are your 3 buys. Let's move on to the bail, and it's Carnival, which has already been under a tremendous amount of pressure, one of the worst, most emblematic names of the return to the pandemic trade. It's back to April 2020 levels. That was just a few weeks after the CDC's no-sale order. Yes, it's a top 5 performer in the S&P today. It's extremely high beta. It's always amongst, it feels like, the top or the bottom names, depending on the market. Why is this one a bail for you?
So for us, you've probably heard this theme now. I've said it a few times. We're really looking at the balance sheet of some of these companies to say, okay, if we do go into sort of more difficult times, who's got the balance sheet to support it? All of the cruise lines really fell into a really, really bad space because of the no sail order, and they're also incredibly expensive to operate. And so even just, docking the ships is incredibly expensive. The maintenance doesn't stop. Even if you're running the ships, you're dealing with fuel costs. And so, they're really getting hit on all sides. Finding labor, inflationary pressures in wages, fuel costs, none of that bodes well. You look at their margins, and right now their margins obviously are negative because they're not making any money, and they just are carrying a massive debt load that they need to figure out what to do with. In a recession, that's really what you want to avoid.
Yeah, debt obviously that needs to be refinanced at higher rates. That won't help as well. Quickly, are you bearish on all of the cruise names? And I should note, none of your buys were, airlines or the kind of travel part of this market.
No, the reason for that, Kelly, is because we are concerned about the fact that oil prices are just staying high longer than even we expected. And the longer those oil prices stay high, it's going to pressure margins on anybody that has to buy any kind of fuel. So it's why we sort of headed towards the hotel names in the travel space. The cruise lines right now, a lot of them actually have quite negative balance sheets, and it's just a hard place for us to get comfortable. So that's really been the reason why we've stayed away. I mean, those guys just had a double whammy in that they were carrying tons of debt and they were getting hit by all the inflationary pressures.
Exactly. All right, Gina Sanchez, thank you so much. We appreciate it. 3 buys and a bail on the travel space today.